Thanks so much for inviting me to present my paper. This is a joint work with Chao, Jiang, and Koch. In this paper, we examine the relationship between the trend in firm profitability and future stock returns. So what's our motivation? Over the last decade, there's a growing literature on understanding the role of particularly a very old model, the discount model, in explaining the cross-section of stock returns. And Ferhat French 2006, using a clean surplus accounting, they seem to assert that fixing investment and book to market, stocks with high expected profitability should have high returns. And similarly, Ho, Su, and Zhang have the same idea, and then they develop an empirical Q model, and then argue that the three-factor model should explain the cross-section of stock returns. Recently, Noe Marx, using gross profitability, shows that firms with high level of gross profitability have higher future returns. And the explanation for this positive relationship between gross profitability and future returns actually is provided by, again, the same authors, Ferhat French and then Noe Marx, and I'm sorry, the Zhang et al. Paper, that the level of profitability is simply a proxy for expected profitability, and therefore, according to the dividend discount model, it should be positively related to future returns. Okay, that's the very basic explanation behind why gross profitability might simply predict future stock returns. In this paper, what we do is actually we argue that the level of profitability reflects a firm's current productivity and held in the context of the current competitive environment for its product market. In other words, whatever the gross profitability gives you in terms of the future information, it's about the recent time. It simply ignores the past or the history of the company. But we know that in the product markets, firms have ups and downs, and then they will have struggles, they will have competition. And how they reach the current level of profitability might be important. Let me illustrate this point. Two firms, Firm A and Firm B, they have two different levels of gross profitability. So all else equal, once again, Firm B and Firm A have different levels of profitability, and this is the Noe Marx setting. Noe Marx shows that Firm A, which has high profitability, have higher future returns when compared to Firm B, which has lower profitability, again, all else equal. What we do in our paper, we took again two firms, Firm A1 and Firm A2. They are all identical, and at the same time, they have the same level of profitability. How they are different is, Firm A1 has a negative trend, so they had higher, even higher profitability in the past, and their profitability is decreasing over time. Firm A2, the same level of profitability now, recent profitability now, but they had a lower profitability in the past, and they are marching up, so they are increasing their level of profitability. We simply argue that this simple trend may also contain information about future profitability and future stock returns. And this is what we are simply testing in our paper, whether the history of profitability, and in particular the trend in profitability, whether your profits were decreasing or increasing over time, have any information about future stock returns and future profitability. In a nutshell, what we find is there's a positive and significant relationship between the trend in profitability and future stock returns after controlling for almost everything under the sun that has been documented to predict the stock returns. A hedge portfolio, long high trend minus short low trend, yields around 85 basis points per month, equal weighted, and the predictability lasts up to 2 years, and it remains significant even after controlling for various determinants of stock returns. Gross profitability we define similar to Noe Marx, which is a very basic or upper level of profitability measure, which is very clean, and it's sales minus cost of goods sold divided by total assets. And according to Noe Marx, this gives the cleanest measure of gross profitability or profitability for a company. And we define the trend by simply regressing the profitability on a trend and then quarterly dummies over the past 8 quarters. We also use 12 and 20 quarters, and the results are similar. And the trend measure simply gives us the trend in profitability over the history of the company. The data, it's a regular data. There's nothing special about the data. NYSE, MX, and Nasdaq stocks from 7777 to 2012, which simply depends on the availability of the quarterly profitability data. We exclude financials from utilities, positive, book to market, and available composite data, and we exclude stocks below $1 to make sure that illiquid stocks are not driven our results. Our first analysis, results for our main analysis, is a sorting analysis. Every month we sort stocks based on the most recent trend and then into deciles. We skip amount to ensure that our results are not driven by any kind of bid-ask balance, and also the investors already know about the trend. And then the results simply suggest that using conference 3, 4, and 5 factor alphas or raw returns, high trend stocks yield higher returns when compared to low trend stocks, and this effect cannot be explained by up to 5 factor models. We also use the Ho et al. 3 factor model, and the results are similar. I want to also show you the double source. We actually have a lot of double source, but two are I think very important. Level of profit, when we control for level of profit, the results are similar. And market capitalization, when we sort stocks into 3 terciles based on the market capitalization and further on trend, we saw that our results are in all buckets of size, suggesting that our results are not simply driven by small stocks, or this is not a simple small stock phenomenon, so it exists in all size terciles. And our regression analysis, we have 4 different specifications. The first one, only trend in profit. In the second one, we control for trend in profit and profit, the level of profit. In the third one, we use the usual suspects, liquidity, momentum, size, book to market, volatility. And in the fourth one, we include both the usual suspects and a bunch of other firm characteristics that has been documented to include the trade stock returns, including the investment profitability, the volatility of profitability, earnings momentum, also accruals, and a bunch of other stuff. Okay, so controlling for those variables, our results remain significant. And we have performed a bunch of robustness tests, including the different alternative definitions of trend, specifications, and also, again, different controls for industry and also using specifications. The results are similar. And additionally, we also use the composition of marks, and we decompose the trend into asset turnover and gross margin components and document that trend in both of them matters. So, very briefly, in the first part of the paper, we simply document that there is a positive and significant relationship between the trend in profitability and future stock returns. And that cannot be explained by the well-documented determinants of stock returns. But we haven't actually so far explored what explains our findings. What is the economic factor that drives the positive relationship between the trend in profitability and future stock returns? First of all, if the trend in profitability is associated with future stock returns positively, according to dividend discount model, then the very first condition is there must be a positive relationship between expected profitability and the trend in profitability, okay? Otherwise, investors wouldn't use trend in profitability when forming their expectations about future profitability. Is that the case? Then, in order to actually explore this, we simply regress future profitability, realized profitability on the past trend in profitability using our full-blown model. And we show that there is a positive relationship between the trend in profitability and future profitability, suggesting that at least the very first condition that trend in profitability might be a good proxy for expected profitability is satisfied. However, this doesn't say so far anything about the pricing, whether the pricing is rational or irrational. So far, all our results are in line with either rational or irrational pricing. Or in other words, so either risk or mispricing can still explain our findings. And we also explore whether risk or mispricing explain our findings. In terms of risk, as I just shown you, we control for 5-factor model, we control for the 3-factor model of the Hu et al. Paper, and our analysis simply shows that we don't find any evidence of risk, or risk simply, the risk that we control, maybe actually I should better word this way, the risk so far we control for doesn't explain our findings. But there's one more possibility that there might be a missing risk factor that we don't know and we didn't control. So, from risk perspective, we simply conclude that the risk factors that we know to explain the cross-sectional stock returns doesn't explain our findings, but there might be still some kind of missing risk factor that might be explain our findings. This is the conclusion from the risk perspective. Now, from the mispricing perspective, so there will be 2 types of mispricing. The first one is overreaction. Investors simply observe the past trend and mistakenly extrapolate the trend and then overreact to the trend, push the price away from fundamentals. Of course, this pushing away from fundamentals will be temporary because it is simply due to investor overreaction. Then over time, we must observe a reversal. We regress simply, to test this, we simply regress future stock returns up to 5 years on the trend in profitability. We observe that the effect lasts for 2 years, positive and significant, and afterwards it disappears. But never reverses. There's no reversal or never reverses back. This simply suggests that the effect that we observe in trend in profitability is permanent rather than temporary. So we can reject the investor overreaction hypothesis, okay? So our conclusion from this test is our results are not driven by investor overreaction, okay? But this is not only mispricing. We may also have investor underreaction story. In this story, trend in profitability will have information about expected profitability. Investors will simply fail to account for this information and will not update the prices accordingly. So as time passes, the market will simply understand the information content of the trend in profitability about future prices, and the prices will converge to the real value over time. Okay? The very first test we actually do to see whether this is the case or not, we simply look at the the earnings announcement, whether investors are surprised or not at the earnings announcement. If investors simply fail to account for the past information, once the information is revealed, mainly through the earnings, then we should see that they are surprised. Do we see that? Well, for the very first quarter, yes, they are surprised. In other words, trend in profitability simply predicts 1 quarter ahead earnings surprise in terms of the return, suggesting that investors are surprised at the very first earnings announcement following the trend in profitability. However, as I just showed in the overreaction analysis, the trend in profitability effect lasts for 2 years. So the return predictability lasts for 2 years. But the earnings surprise analysis suggests that investors are only surprised at the first quarter. So this evidence simply to me suggests that we have some evidence of underreaction, but this evidence simply cannot account for all our evidence related to the relationship between trend in profitability and future stock returns. I apologize from the discussant. I think I mentioned this to him. Based on the editor's suggestions that we submitted the paper, we also did some analysis. I'll just skip that one. On further analysis of investor underreaction, we followed Bradshaw, Richardson, and Sloan in 2006. And in this analysis, we simply looked at whether analysts, sell-side analysts who are professional information mediators in the market, do they account for the information in a trend or not? So what we do, every year, we simply regress the analyst forecast errors. These are analyst forecasts related to the upcoming annual earnings surprises, so 1 year ahead. So, assuming actually we observe a trend in December, month 1 is simply analyst forecast related to the next actually annual announcement, and this is in January, February, and so on. And the beta here simply measures the relationship between analyst forecast errors and the trend in profits. If analyst forecast error simply depends on the trend in profit, that simply means analysts fail to incorporate the information on a timely basis. And a decreasing trend in the beta simply suggests that they incorporate the information over time. In other words, the positive and significant relationship simply suggests that analysts are not properly using or the full information in trend in their forecast, and they are incorporating this over time, which is related to the idea that they are simply underreacting to the information. So this is our main evidence that our results might be driven by, or at least have some flavor from investor underreaction. Now, turning back to our results in the paper, so now we do have evidence that, again, at least partially, our results can be explained by investor underreaction. But what is the mechanism that drives this investor underreaction portion of our results? Is it investor confidence? Cooper, Gutierrez, and Hamid simply suggest that the momentum effect is stronger following upward market movements or positive market returns over the 12 or 36 months. They suggest that after positive market gains, the investors become more overconfident, they rely more on the private information and simply ignore the public information, and that's why we observe investor underreaction. Is that the case? We tested this and we don't find any evidence of effect of investor overconfidence in our underreaction results. Investor sentiment? Baker and Bruegel suggest that investor sentiment plays an important role in the asset pricing, and Stambau and Jiang document that around 11 anomalies, the sentiment plays a significant role and explains that it is part of the 11 anomalies recommended in the literature. We tested the results and showed that investor sentiment do not play a role in our findings. So investor sentiment is not a channel that drives the mispricing findings in our results. And we also controlled for the mispricing factor in Horenstein and Jiang and showed that it also doesn't explain our findings, suggesting that a systematic mispricing factor as captured by their factor doesn't explain our results. So, very briefly, our conclusion is we document that there is a positive and significant relationship between trend and profitability and future stock returns. And we simply rule out the investor overreaction hypothesis. We also conclude that the well-known risk factors do not explain our factors, but that doesn't preclude the idea that some unknown risk factor may still explain our findings. We have strong evidence that there is some kind of investor underreaction that might potentially explain our findings, but in that investor underreaction, overconfidence, investor sentiment, or the systematic mispricing factors do not play a role. Thank you.
Thank you very much, Aurelio, for inviting me. It's always a pleasure to come to Mexico and back to my second home, Itam. I love to be here with them. I have the chance. So I'm going to discuss a very hard paper to discuss because it's already under revision, so you don't have to listen really to me, you have to listen to the referee. So I feel full freedom to tell you what I think it could be nice to do if you want to do a follow-up on the paper. So the summary of the paper is impressive empirical exercise. 18 very long tables that are self-contained. You can read the tables, have all the information there that is later explained, and it's interesting insight regarding profitability trend. The paper main conclusion, the version that I read, are three. There is information in profitability trend beyond that observed in spot profitability, defined as gross profit over total asset. Trending profitability predicts stock returns and profit over the next 8 quarters, and evidence is consistent with risk-based explanation. You change that based on the suggestion of the referee or the editor, and I think that's a very good suggestion. So I'm going to talk about these 3 dimensions that are the main conclusions of the paper. The first one is there is information in profitability trend beyond observed spot in profitability. It would be interesting to know where is that information coming from. Is it related to the same sort of risk as spot profitability, or is it coming from a different source of risk? Which companies, industries are more sensitive to this profitability close shocks? How persistent this shock is? So first, insight is in a table that you provide. You said when you sort on size and trend profitability, you see clearly that the effect diminishes in size, and when you add momentum for high, for large stocks, the high minus low alpha disappears. It's not a bad thing. Alpha, in my opinion, it's not really that important in the sense that there are already 300 factors proposed in the literature. So we will always find a combination of factors that kills any alpha. The important thing is where is that coming from? And here you have some idea. Size and momentum seems to be some sort of factor information. Then you report two portfolios, equally weighted and the value weighted. Personally, I always like to use value weighted, equally weighted portfolio, overload on small stocks and liquid stocks. So value weighted is always an easier, we could say, strategy to implement. We don't have to short so many liquid and small stocks. And if you look at size, everything seems to be driven by the extreme portfolios. In the middle, there seems to be no effect on trend profitability. So I do 9 minus 2 instead of high minus low, the effect doesn't seem that high. So in that sense, it's not a negative, it's just size is quite important. So then I plot the cumulative returns. And I would say up to 1998, you're Warren Buffett. After 1998, Warren Buffett would cry if he sees this result. Compare your equally weighted. I only use equally weighted in my analysis because I didn't have the value weighted. So this, with the market cumulative return, this seems like it's like around 600%. Yours is around 4,000%. So my question is, what is going on here when everything was flat? Yours explodes. Am I shorting .com stocks that or companies that were highly stressed here? And is that strategy even implementable? Is my question. This is quite different with respect to the average market. The average market was flat. Yours was exploding even faster than before. So what stocks are you shorting here? I think it's interesting to know. Then I decided to do some further tests to understand what are you capturing. So my idea is, are you capturing something different than normal market? Are you capturing some source of risk that is not captured before? So the first thing that I did is replicate your results and not only report alphas, but correlation with respect of other factors. And in yellow, you have the ones that are statistically significant. Something that impressed me of your factor is that it's uncorrelated with the marketplace. The beta is insignificant. It's only correlated with momentum. These are the ones that you use. And if you use the 4 factors based on Q theory of Sang and its co-authors, sorry, I don't remember the other two, but I always remember the. Yeah. It seems that return on equity is highly relevant, at least for the equally weighted one. And the alpha goes diminished by half. Again, it's not important for me, at least, the size of the alpha. I'm trying to understand what is this trend in profitability. So it's really unrelated with the most usually factors that are used in the literature. So no one, it is expected that when you double sort using this characteristic, you will still have an important effect. What if we use return on equity? This seems like a better benchmark for me to use than the other. And then I want to know if we are capturing a different source of risk. So for that, I did the following. Sorry, this is not promotion, but I already have the programs done, so it's the easy way to do for me. I estimated the rank of the beta metrics generated by your factors using standard portfolio. So what do I mean by estimating the rank? If we use observed or empirical factors to test underlying unobserved factors. So if your proposed empirical factors is correlated with your observed factor, the underlying beta matrix increases in rank. So for example, the Fama French 3 factors usually gives you a rank of 3. The Fama French 5 factors usually give you a rank of 4 because book to market seems redundant in the Fama French 5 factor. So I did first test the Capel, I report average R-squares, I rank. The Capel is just the market portfolio. It gives me a rank of 1 for everybody. I add profitability factor of no remarks to the Capel, and the rank increases to 2 when I use 25 signs of book to market as response variable industrial. Leveler, Shanken, and somebody else, I don't remember, sorry. They propose to use 25 size and momentum book to market plus the industrial to have more dispersion beta. It always increases to 2. Momentum, when we use 25 size and momentum sorted portfolios, this stock profitability doesn't seem to be capturing another dimension in which asset moves. Now I added your factor to the Capel. When I use size and book to market industrial or size and momentum, it doesn't increase the rank. So it's not capturing an additional risk source. When I use momentum, it does. Again, it seems that portfolios highly correlated with momentum are correlated with your factor. Then I use Capel plus peer view plus trend, and I get 2 in all of them. But look, when I add your factor to, in a case where the Neumark's factors add the rank, your factor is not adding. When I add your factor to the case of the Neumark is not adding to rank, your factor is adding to rank. So it seems that, if anything, I don't know how related it is to Neumark's. And when I use your factor alone, this is, are you capturing different source of risk? The rank is 0. So the risk-based explanation, I'm not so sure that is the way to go. Maybe it's a
Carhart,
sorry?
Carhart 4-factor model plus the trend, whether it gets something or not?
I can check, I'll tell you. But your model by your factor by itself doesn't seem to work. So what do we learn from this exercise? Trading profitability seems more related to momentum and Q theory, especially return on equity. Trading profitability seems to have a larger effect in small firms. It does not seem to be related to the Fama French factors. That's why when you use those characteristics, you still have the alpha. And it does not seem to span any dimension in portfolios, except when we use portfolios sorted by momentum. So my question is it really price, or what are you capturing? And finally, can we implement this strategy given what we observed in 2010? Then I have some other things to, this is very simple. You show that trading profitability captures gross profit. Neumark says that profits are good predictor of growth in profitability. So it may be that both are highly persistent. That's why I say analyzing persistencies is important. Finally, go very fast, I'm sorry. My opinion is, in the third dimension of your conclusion is evident consistent with respect to explanation. I think this is the weakness, and when you can add more on a follow-up paper, in the sense that you don't find any positive evidence for risk explanation, that you find negative evidence for some behavioral explanation. So I decided to check your factor with some Chen, Roland, Ross, and this is also, I think, something positive. It seems correlated with shocks to industrial production, and that decreases, but and the third premium both seems somehow correlated. So here you have some macro variables to think about whether the underlying primitives of the economy that are linked to your factor. So conclusion is a very nice empirical work, very robust. You do a lot of tests. other models than Fama Friend seems more suitable to use as benchmark. Profitability trend seems to be not spanning any additional stage, so I think that it would be nice to link it to the interaction between characteristics or factors. It seems more a characteristic than a factor to me, and you already did revisit the rational versus behavioral explanation. Since I don't find correlation with any underlying factor, it's hard to find, to me, a rational explanation. And again, don't worry, I wouldn't worry so much about the alphas and using, because as I said, there are 300 factors that are proposed. I didn't add it here in case Aurelio upload this to the internet. If you use a combination of the Q theory and the CRR, the alpha disappears. But alpha is not important. Important is what are the economics behind this? 300 factors have been proposed. Any new factor will be some combination of those. So the important thing, in my opinion, and what I would like to see the follow-up version after this is published is, what is it? What are the economic primitives that are driving these measures that we find? Thank you, sir.